Now, most people's investment understanding is really based on secondhand knowledge, potentially having picked something up here or there over the internet, or just knowledge or best practice that they've picked up off of their parents, which may not ultimately be best practice in reality. Now, if we go back to the fundamentals of investing, we have two types of investments. We have defensive investments and we have growth investments. Now, defensive investments are cash-based investments. They basically give you what's on the tin. A term deposit pays you 4%, a cash investment account will pay you 2 to 3%. There's very little to no growth prospect on these investments if held to full maturity. Some examples would be cash, fixed interest investments like term deposits, or things like bonds or annuities. On the other side, we have growth investments. Growth investments are capital investments. They're really where the power in our portfolio comes from. They have two types of return. They have the growth return and they have the income yield. So if we think of examples of growth investments, we have things like property, Australian shares, international shares, property securities, etc. Now, the growth investments are much like the accelerator in the car. The defensive investments are like the brakes. If you go into a car and you don't have brakes, you're probably going to crash. If you get into a car and there's no accelerator, you're not getting anywhere. So the allocation of our assets between these different subcategories, defensive and growth, and then the further subcategories of cash, fixed interest, property, Australian shares, and international shares is what we call an asset allocation.